Hello and welcome. You're watching the ET NOW Roundtable with Citi India, and we have the whole team with us. I'm Harsh Saita, with me Sajit Mangat. And let me start off by introducing the panel. Surendra Goyal, first off, Head of Research at Citi India. Great having you here, Surendra. Rashi Chopra, Director, Metals and Cement. Thanks for coming in. We have Kunal Shah, Director, Banks and Financials, and we have Ashish Kanodia, Director, Consumer and Retail at Citi India. Thank you so much, all of you, for coming in. Surendra, let me start with you. With regard to the Q2 earnings, the print has come in slightly better than what estimates, consensus as well as you predicted. Give us a sense of what this means in terms of tailwind and setup for H2 FY26. Are you penciling in a possible positive upside? Didn't seem like in your report, but are we likely to see that in H2?
Okay, yeah, so first of all, thanks for having us on the show. So on Q2 earnings, EBITDA growth is like around 12% year over year for BSE 100 companies, which is slightly ahead of expectations. But I think the more important part of earnings was that in October, November, we have not seen any change in consensus outlook for earnings. Over the last 15-16 months, we had seen consistent downgrades, and that was essentially a big overhang for the markets. At least we have seen some stability. Now, I think as we go forward from here, we really need to see the benefits of GST, how much of it sustains, right? We obviously saw a very strong month and a half, but I think that how much of it sustains is something we need to watch out for. What is key is obviously next year's earnings need to grow at least double digits. Current expectations are 13 to 15% depending on whose numbers you look at. But I think back to that double digit kind of trajectory is going to be important. And when we look at it across sectors bottom up, it does feel like that we are set up reasonably well as we go forward. A lot of sectors are seeing an improvement in growth, particularly like banks, which Kunal will talk about, consumption. So there has been a lot of, in the form of stimulus, even before GST. I think all of that should help earnings as we go forward.
And with regard to the rate cut possibility going forward, we've had the governor come in and speak about that. That's been the latest. Give us a sense of what that means, because that means that the government as well as policymakers have already gone aggressive, but there's yet some amount of firepower to come. So I'm trying to get a sense, does this mean that there will be a growth upside as well as an EPS upside in FY27 to what you are already suggesting?
Yeah, so I think the way to think about it is a lot has already happened this year. We already seen multiple rate cuts. We saw the changes to tax rates in the budget. Then we saw GST, lot of liquidity infusion in the market. I think a number of steps have happened. And all of that is kind of helping the market, helping earnings as we go forward. I think all of those things will help earnings as we go forward. But from a foreign flow perspective and multiple perspective, I think a lot of people are still waiting and watching out for the trade deal with US. That, in my view, plays a big role as well in terms of the market upside from here. Because if you think about what's happened in the last 7-8 months, India went from a point where the consensus view was that India is relatively better placed compared to emerging markets, other emerging markets. And we went to a point where effective tariffs were on the higher side, even in the same peer group. So I think that clarity is also going to be important as far as market is concerned. But yeah, earnings not seeing downgrades, stabilizing, okay, and going back to double-digit trajectory next year, I think that's all going to help with more clarity on the trade.
Last 2 months, even ever since this GST effect has come into being, have you seen consumption, getting a big push on the ground? And when you say that, okay, we are not seeing any downgrades yet, and we are not seeing any upgrades, but consumption should have, pushed some of the upgrades for many of the sectors. Why isn't it happening?
Yeah. So see, a couple of things there. One is, like when I talk of earnings remaining unchanged, that's at an aggregate level. It's not only consumption. That's point one. And secondly, I think a lot of companies are still in wait and watch mode because you saw strength towards the end of September. GST came into effect, right? And then that sustained into the first part of October. But companies really want to see how much of that sustains as we go into November and December. Right? Typically, post the festive season, you do see a bit of a lull. So I think companies really want to see that, and that's what even analysts are waiting for. That clarity is important to say that there is significant upside to consumption estimates. But overall, the point I was making is, yes, banking numbers were pretty strong. Okay, consumption was okay. In fact, both consumer discretionary staples slightly above on EBITDA. And that is what I think resulted in the earnings being better as far as the quarter is concerned. Okay, so yeah, so that's the point I was trying to make earlier.
And India within the emerging markets, MSA emerging market is still underweight. Do you see that there will be a position shift with respect to that underweight that we are in emerging markets?
Yeah. So see there, if you kind of step back and see why did India go to an underweight? If you look at the last 2 years, for the most part, India has been overweight as far as portfolios are concerned. In our view, I think a few things happened this year. I think the first was late last year when we saw earnings starting to get downgraded. Okay, till September, India was chugging along, doing well. And then you saw earnings starting to get downgraded. Expectations were high, earnings were coming in slower. So that was the first thing, which I think earnings stability, I already spoke about that. And next year, if people feel comfortable that we are going to go back to double digit, that point will be addressed. The second issue was around the trade deal, where you went from a point where you thought India would be best placed or better placed to a point where India was not so well placed. I think clarity on that is important, and to that extent, that's an important catalyst for the market. Third thing, which is also kind of important, is the whole AI trade, which has helped a lot of markets which are more exposed to AI plays. Right? India at this stage, you don't have a lot of plays on AI, and which also has not helped the market this year. So our view is that at least a few of those things reversing, firstly, earnings stabilizing and visibility of good growth next year. Secondly, trade deal as and when the clarity emerges. I think those are things which will help. The setup is pretty favorable, right? If you think about it today, like we have already had a lot of selling by foreign investors. India is at an underweight level, which is pretty much close to the lowest in the last 20 years. Okay, so the underweight is there. India has underperformed emerging market index by almost 25% this year. Okay, so I think a lot of those things are in favor, and domestic flows continue to remain quite resilient. Okay, so the setup is there. The first thing, which is earning stability and visibility, is starting to come in. We already seen some signs of that. And then trade deal, I think, could be the next catalyst. I think as those things play out, you should see India's weight in the portfolio kind of inch back up. I think the other point here, which is important, is India's weightage in the index itself has gone up substantially in the last 5 years. So while we might be talking about a little bit of underweight, overweight, I think it's important to remember that 6 years back, India was, say, 8.5%, 9% of MSCI EM. Today, that number is double of that. So I think that context is also important when we are kind of thinking about underweight, overweight.
Ashish, let me come to you. Surendra touched upon consumption. Give us a sense on where do you feel the biggest value as well as opportunity lies within that consumption basket. There was an upside surprise where one of the largest paints players is concerned. At the same time, we've not seen consumer durables surprise materially on the upside yet. Where is it that the risk reward is most favorable?
I think durables is one space where we believe that the risk reward is very favorable. And if you look at the category, right, it is a category where the demand is non-perishable. So if someone who wanted to purchase a AC this year has not purchased it, it's not that the demand is lost, right? So it just get pushed next year. And we have seen this playing out with jewelry, when during COVID, a lot of marriage did not happen, and then you have seen a very big pent-up demand. I think durable also fit exactly in that place, that this year was a washout year given the early monsoon and a prolonged monsoon. We have not seen a second summer, which typically happen. And then there was a GST rate cut, which on a large ticket discretionary category have a big impact. So to that extent, I think risk reward is much favorable on the durable space.
In the paints business, we're seeing the leader now coming back aggressively into the market after last 6 quarters of hyper competition in the market. Do you see that the large players are now going for the market share and maintaining the market share at the cost of margins and profitability?
I think that's what the company has been communicating, that they want to now focus on market shares, given that if you look at the raw material prices, it has been benign. So that's giving them some benefit in terms of passing on the discounting. But the competitive intensity remains elevated, especially if you look at the discounting, rebates, etc. That has actually increased over the last 1.5, 2 years. And especially if you look at the new consolidation also which has happened, the competitive intensity is about to increase. So we think while the competitive intensity is here to stay, but yes, there could be some benefit because of soft RM prices.
Ashish, if I were to come to you on durables one more time, give us a sense on the pickup. Will it likely happen in Q3? Because it's generally a seasonally slightly more subdued quarter, even though you've got festive which comes through. But post-festive, it starts to get slightly more subdued. What's the sense there? Or do we wait for Q1 FY27, where we start to see the summer kick in and the summer sales start to come back? So at what point does that growth start to fill up, in your opinion, given everything that's played out in GST?
Sure. So see, 3Q will be slightly better versus what 1Q and 2Q has been, partly because of the GST rate cut benefit. Because if you see from 15th August to 22nd September, almost 5 weeks, there was almost very negligible sales. So 22nd September onward, you have seen some pickup. So because of just that deferred demand, some pent-up demand, you will see some pickup. But I think 4Q is going to be a much bigger quarter, and that has historically been the trend, because 4Q around Feb and March, the channel starts to build up inventory ahead of the summer season. So if you look at 4Q and 1Q, this 2 quarter almost accounts for 2/3 of your revenue. So I think 4Q would be a much bigger quarter where you see a much bigger benefit coming in.
Surendra, IT, numbers were better than expected. Means we started the quarter on a very muted, and we thought that it will be a bad quarter for IT, but many of them surprised because of currency depreciation as well. But do you see going into the second half of the year some kind of revival happening for IT, because we saw the IT index rebounding nearly 4% in November itself?
Yeah. So on IT, I think you will few things there. Firstly, you'll have to look at first quarter and second quarter together. Okay, what happened in the first quarter, the June quarter, was that the numbers came in lower than expectation, and expectations came down. Okay, so we went into September with a really low bar as far as expectations were concerned. And when you look at the numbers, they are slightly better than that. So if you look at the year-over-year numbers for, say, the top 10 companies in the sector, the growth rate YOY is still the same. It's approximately, give or take, 2% year-over-year. Okay, so the important point here is that we are still stuck in a low growth trajectory because of a bunch of reasons which we can discuss. And this is the third year of low growth. If you take our entire average, in FY24, growth was 2%. FY25, it was 4%. This year, it looks like another 2%. So the industry really needs to break out of this low growth and at least go back to 6-7% growth for any meaningful upside on the sector, which at this point of time, we are not comfortable to call out. Okay, all the variables when we look at the US macro, we look at what's happening in the GCC space, we look at the AI productivity, which is an integral part of all deals. Still not comfortable to call out that kind of a recovery. We are building in some recovery next year, but not a strong recovery.
Are you building in also revenue deflation as well as AI comes into play?
Yeah, so that is a part of how we build in numbers. We really don't build it in explicitly, but increasingly when you talk to companies, it is a part of all new deals or renewals as and when they happen. Some of the companies have been calling it out very vocally. They are doing it actively. They are going to their top customers and offering meaningful productivity or savings. So it is starting to happen, and it will continue into next year. So all of these things, one needs to kind of think together. And if so I think compared to the current level, will things improve? Possibly they will, because we are at a really low level. This is like the third year of slow growth, which this industry has never gone through. Okay, but how fast is the recovery is important, and we are still expecting a moderate recovery.
And what will lead to this recovery?
So it's a bit of quite a few things coming together. One is clients generally around tariffs, etc. There was a lot of uncertainty. So there were cancellations, pauses, people really going slow for a few months. That ideally should not be the case next year, at least based on what we can see today. So that is the first thing which is in favor. short cycle spending has been really muted for the last couple of years. So hopefully as things stabilize, a little bit of it comes back. Again, that's a starting point assumption that we are also building in. Okay, and third, we'll really need to see, but last few years, couple of years, incremental budgets have been almost entirely going into AI. Okay, now if that kind of starts normalizing a little bit, maybe there is a little bit more room to spend on other parts of technology services. I think all those things really need to come into play for the industry to see that growth acceleration, the growth pickup we are talking about. But I think the market expectations are much higher than what we think can happen. So which is why we are still cautious on the sector. Like one quarter here and there is fine. Okay, you will have quarters where things are a little better. I think the direction is more important. And that continues to remain quite muted. And the other thing we struggle with is when we look at US listed stocks in the same sector. Okay, the multiples are very, very different. Okay, like names trade at between 10 and 13, 14 times earnings. Whereas in India, like stocks trade between whatever, 19 and 25, 30 times earnings, even 40 times earnings. So clearly the valuations are, and these are global businesses. So we understand the domestic mutual fund flow helping these stocks perspective. But how much of a valuation premium is always a subject of debate.
Kunal, let me come to you. ROA lift will be delayed even if it's 25 bips, or would you imagine that the ROAs will be more manageable and we've hit the bottom and now we will go up even if there is a 25 bip rate cut?
So that's very interesting question, and it's been debated all through 100 basis points of repo rate cut. But if you look at the stability of ROAs for most of the leading banks, in fact, all of them, they have been able to sustain the ROAs. So there are enough of levers which are available, be it in terms of operating efficiency or maybe credit cost. We are seeing like asset quality very much in favor of banks, very low credit cost which is coming in. So that has been able to offset any pressure on margins, and they have been able to sustain the ROAs even with 100 basis points of rate cut. So we believe like that might still continue even with 25 or 50 basis points of rate cut.
Kunal, one of the themes which has played out this year is public sector banks versus private sector banks, where PSUs have outperformed the private sector banks. What's your view on them?
Yeah, so when we look at it over last 3-6 months, in fact, PSUs have outperformed by 10 to 15% to Bank Nifty. And the key reasons for that have been, again, the sustainability of ROAs, which was the question. Third quarter, I think people always thought that with limited treasury gains, we would see ROAs coming off for PSU banks. But somehow, all the PSU banks, they were able to sustain ROAs above 1%. So firstly, in terms of the margin decline, that was not very high across all the banks. Asset quality, it was again like a very low credit cost. And growth, few of the banks have still been able to outperform the industry average. So if this sustainability of ROA continue with respect to PSU banks, then maybe compared to that of the private banks, we might see this kind of an outperformance continuing in the near term.
And you think the valuations converging for PSU and
Not really. So there is always a valuation gap, and still it's huge. Okay. So most of the private banks are still trading at say 2.2 times FY27 book, while PSUs are closer to like say 0.9 to 1 odd times. Okay, so to that extent, we won't see that valuation converging to that extent. But yeah, could there be some kind of more uptick in PSU's valuation if sustainability of ROA is there compared to that of private banks? Because most of the private banks have few event-specific risk which is there, and that's the reason it's holding them back. While PSUs, we are not seeing those risks, and we have seen the catch-up in the valuations.
Your pecking order, if I can ask you, if at all there is a rate cut, what would the pecking order be? Would it change at all? Would it be NBFCs above banks, even despite the kind of re-rating we've seen in NBFCs? What fabulous returns, right? Kunal, Shriram Finance, Bajaj Finance, they've been stupendous this year, yeah.
So Shriram has been our topic all through, and I think today, even at this point in time, it continues to be the topic despite its significant outperformance. But otherwise, when you look at it in terms of the growth expectations, they are very well set in within the NBFCs. So maybe with respect to some of the large NBFCs, we are not seeing too much of upside from the current level. While for banks, yeah, so even like mid-sized banks, if you look at it, so now the entire narrative will be around the growth. I think margins is largely getting built in. Asset quality, people know that there are no further risks which are coming up. So whosoever can outperform on the growth, we could see the growth premium getting assigned to those stocks. And I think mid-sized private banks can really outperform on that front. So the preference would be more towards a mid-sized private banks as well.
Ah, interesting.
Surendra, if you look at, you're penciling in a better second half for the full year. What could be the surprise for this? Means, is there a negatives that you will look out for because there are more global headwinds? Because domestically we have a good tailwind coming in terms of consumption, in terms of GST cut, in terms of tax cut, and maybe rate cut, which is there. But globally there are lots of headwinds which are there. Is that going to be a spoiler for us?
Yeah, so see, couple of ways to look at that part. Firstly, from a growth perspective, is there a significant incremental headwind from here? I think if we get a trade deal with the US and which is like reasonably favorable, then I think one would be less worried about that. And anyway, from a earnings perspective, the sensitivity is not as high because India is a largely domestic economy and even the market is more a representation of domestic businesses. The second is more from a flow and global market correlation perspective. So that obviously, if you have a big correction in global markets, then that could also impact India. Now, the thing is that India has not kind of really participated in the upside. So to that extent, the downside also, India's correction could be limited. We already saw last week, there was a bit of a wobble because of AI, right, or wobble on AI. And you saw that some of the other Asian markets corrected a lot more. India was relatively much better. There was outperformance. So I think that is where the risks are. Like if you get a big global correction, then obviously that's something to keep in mind. But otherwise, we feel pretty good about where we are and how we are set up going into calendar next year.
You briefly mentioned about the domestic flows, how is sustaining the valuation, and that's also allowing the time correction for the market as well. Do you see that to be the base for the Indian markets? Because any investor would like to have a correction to enter, and the flows are maintaining itself so that the correction doesn't happen to the extent that's required.
Yeah, so see, a couple of things there. One is, if you look at the last, say, 5 years, we have seen domestic flows being largely resilient, right? And we have seen a lot of things play out in the last few years. There have been periods of low return, right? There have been periods where some of the other asset classes were looking very attractive. We have seen all of that. And yet domestic flows have been pretty resilient. So we really need to see how much of it sustains. But at this point of time, it feels like that we have seen a lot of headwinds and yet the flows are sustaining. And this year, we have also seen a lot of primary market activity. Okay, so that liquidity has really helped absorb those flows as well. And despite that, the market is up for the year, although it's underperformed other markets. That is kind of because of the strength in domestic flows. So that's important, but it does feel like that at least in the near term, unless you get any event which triggers meaningful downside, people panic, etc., it does feel like that you should see that at least the direction sustaining, right? It does vary month to month, quarter to quarter. I think those kind of variations will be there. But longer term, if you look at where Indian households are in terms of equity participation, I think there is still room to go up if you take a slightly medium to long term view.
Surendra, FII holdings at decadal lows. Firstly, does that reverse, if at all? Of course, trade deal you did mention will be a big positive basis your conversations with FIs, but what else? And second, if that to reverse, what is it that will benefit in terms of sectors? Because SMIDs have already seen good FI participation, but the large caps are the ignored side from what I understand. So which are those sectors, spaces, opportunities?
Yeah. So see, I think the way to think about it is why were foreign investors historically most of the time overweight on India? Because India really offered good earnings compounding, okay, and solid 50, 100 companies, right, which were kind of great companies even in the global context, which people could invest in, right? And obviously a favorable macro political scenario, all of that at the background. That is the reason we have generally seen India being overweight. Now, what changed? As I mentioned earlier, I think the earnings started disappointing last year, late last year. Okay, so earning stability is important. AI Okay, I think that was like a big wave which did not benefit India. It lifted a lot of boats but India, right? So as all of those things normalize, I think there is a reason to believe that if India can offer that double-digit compounding. Now, in terms of which sectors benefit, I think the good thing that has happened in the last 5 years is the market has broad-based very substantially. If you look at any category of market cap, number of stocks above $10 billion, $20 billion, those numbers have really gone up substantially in the last decade. So clearly there are a lot more options. And in my view, that makes the market more resilient, because when some sector is going through a bit of a down cycle, there will be somebody else, some other sector which is doing well. So clearly it offers people a lot more options and opportunities to invest in the market. What can do well? I think the large caps have obviously underperformed, right? Banks obviously is one sector which has done well this year. But prior to that, there was a significant underperformance that could do well. Then there are select large cap stocks, right, which have multiple businesses, which have again done well this year, but did not do well in the past. I think those kind of names, and then I think the market is clearly getting more broad-based. So there will be enough opportunities even on you call it SMID, you call it whatever you want to call it, but across asset classes, across market caps, there will be opportunities to play.
Okay. Thank you, all of you. And viewers, there's plenty of food for us to digest. Let's digest all of these thoughts, try and dissect them. It's always great to speak to a huge panel and of established analysts, of course. And here we are. And thank you, all of you. And thank you, viewers, for tuning in. From Sajid, myself, that's a goodbye.